for being with me. And as I said, this analysis will be more detailed than usual. There are some really important trends that I want to bring to your attention as we start by looking at gold. Over the last 3 days, a bit of a moderate weakness into the close on Friday, but the important thing to keep in the back of your minds here is that this consolidation above that 1190, 1185 zone is very significant thus far. And that is a very important indicator that we're looking at for the model going forward. We're going to be looking at the 1970s bull market in precious metals here. There are a lot of interesting comparisons that we can make. Obviously, not every single comparison will be exactly the same, but I think this is important to understand because markets often tend to rhyme throughout history as the impulsive waves and the correction waves in markets play out through human nature. So just for reference, again, we are looking at the price of gold from 1970 through 1980. This is after the market broke the gold standard and forced Nixon to remove gold from backing of the US dollar. The market forced that to happen because the United States and many countries were printing too many dollars. From that break at $35, we saw a 470% rise to roughly $200 into 1975. We're rounding these numbers, roughly 200. From 1975 to 1977, there was roughly a 50% correction from 200 down to 100. So keep in mind, we look at these numbers 200 to 100 and we say, oh, well, that's only a $100 correction. But for people that were living through this and who were buying anywhere above $100 in the early 70s, they lost half of their money in this correction. Very similar to the 50% correction we have seen in gold from above 1900 down to right around 1,000 in this recent correction. From the 1977 bottom, gold then experienced a 750% gain, reaching $850 in 1980. That 750% gain from this low, was a 350% gain from the previous all-time high, that 200 figure. This entire period took 9 years to play out, 1971 through 1980. We're going to zoom in on the following period here, 1975 through 1979. In other words, we're going to zoom in on this correction. Here we can see again the data. Again, this data is from the Federal Reserve Board itself. And we're seeing this nice 50% correction followed by a rebound. This entire process took 3 years and 9 months to play out, from 1975 through almost the end of 1978. Now, I want to draw your attention to this part of the correction, because this is the stage that we are in right now in the gold market. The 50% drop. We're looking at gold from 1975 now through late 1976, a year and 9 months. Here was the 50% correction. This was a bottom, right? We all know that. We all know this was a bottom because we can look back at history and see this. So let's pay attention to what happened after a bottom formed in this 50% severe correction. I want to draw your attention to the pink shaded area right here in late 1976 into early 77. What can we see here? From the bottom, gold broke out of the downtrend that it was in and then consolidated and followed this dashed line above a previous high. It consolidated after making a higher high. Bear markets are characterized by lower lows and lower highs. A lower low, a lower high. A lower low, a lower high. A lower low, a lower high. And then what did we have here after that bottom? A higher high. So there was a consolidation that formed here for about 3 months, with important highs coming above this 1976 high. That's the critical thing to pay attention to. And these are very early technical signals that we are looking at when we zoom this back out, that were showing us that this was the last time to buy gold in the bottoming zone at roughly $100 before, within the next 3 years, we saw a 750% rise. This little blip right there, the consolidation after a higher high, very significant. So, let's look at the current action. What do we have here? An October high, and again we're using our GLD fund. So these numbers do not correspond on the y-axis to the price of gold, but, they do correspond. They are not the exact spot price levels. They correspond on a perfect 1-to-1 ratio. So we had the October high around 1190 on gold, the low at 1045, and this break above the October high. The former resistance zone has become a support zone. We can see that 1, 2, 3 attempts. The price of gold has held above this support zone now. So we're seeing a consolidation above a new higher high, above a broken downtrend. Very important. Let's put this in the proper context. We haven't shown this chart for a number of weeks. We're looking at the entire move from gold now from the lows of 2000. The 10-year rise followed by almost a 5-year decline. So compared to the 1970s, this move is taking approximately twice as long across every metric, across every time frame to play out. And we've had that nice bounce exactly where we were hoping the first support level would come. If you go back and check the videos from 3 or 4 months ago, we were talking about this. Very nice to see that at the first support level here, the 2008-2010 horizontal support resistance level, as opposed to some of these lower ones. We've had a break, this downtrend broken now, as shown in the turquoise color. So this is for reference where we find ourselves. Now, once again, we are seeing that consolidation above a previous high. Very similar to what we saw in the 1970s, in early 1976. So this leads me to believe, as someone who understands the fundamentals, yet who likes to map things and plot things in a way that allows us to see what the actual market is showing us. We are seeing these similarities to the 1970s that are very striking, but taking about twice as long to play out. So from the high to the low here in gold, almost a 50% correction that took roughly 4.25 years to play out. So what will we be looking for now that we have broken out of this downtrend and are consolidating is roughly a 4.25 year time frame to re-challenge these all-time highs. Now notice, I don't fit in with either of the extreme crowds here. There are some people saying gold is going to $5,000 next month or $2,000 when the market opens on Monday. I don't believe that. I'm talking about over 4 years that this rise might take. And there are other people in the mainstream media who just say gold is going down to 700. I don't believe that either. I'm basing this based on a model that we are looking at that we have some important similarities from the 1970s. So how is this going to look? This is the model that seems the highest probability to me right now. This consolidation looks like it is going to break to the upside at some point in the next 4 to 8 weeks. That's how it's looking right now. It could take a little longer. Sure, could it be 12 weeks? Could it be 3 or 4 months? Absolutely. But this is a very bullish consolidation that we're seeing right now. When we see that break, we will be looking to challenge the magenta colored long-term trend line here that comes right around this 1300 support level as well, this resistance level, which corresponds to the early 2015 high right here. So there will be a challenge here, and gold will not break through this downtrend line right away. What will most likely happen is we will see a backing off from this. And this will be really good from a psychological standpoint because everyone who became excited here in the last month or two will start to lose interest. And this is exactly what sets up the market for the next run higher. All of the people to just start following will begin to lose interest toward the end of this year, the middle part of 2017. So then what will the market do? It will then begin to accelerate. Once all the people have sold who desire to sell, the sellers will be exhausted and we will see this long-term downtrend line broken to the upside. We'll look at hitting somewhere around this 1450 high from 2013. And when you have a series of moves, 2 forward, 1 back, 2 forward, you then get what is a trend channel. You have 2 highs, you have 2 lows, and we begin to map the new trend that's forming. And I anticipate this trend will look something like this final part of the downtrend, just trending to the upside. Slowly but surely, 2 steps forward, 1 step back, taking us higher. We'll probably see a few more of these moves, taking us to the later part of the decade already. So we're not talking about a massive move here. Perhaps this might be a 30% move higher over the course of the next 3 years. But this entire thing will be forming this long, almost 10-year drop and rise, very similar to what we saw in the 1970s. And there will come a point then when gold gets ready that it will break higher out of this trend channel, just like it broke lower right here in late 2012. We'll see one of these breaks higher and then a challenge. And we can talk about that challenge of the 1917 was the actual high from 2011. That challenge will take its own shape. We'll talk about that when we get closer to that. But this is the model that seems the highest probability to me at this time if you believe that the gold market consolidated for 29 years, as we have shown, and that the initial break above a 29-year consolidation lasting for 2.5 years is not the end. I have not seen markets that end so quickly after consolidating for 29 years. So what it shows me is that this move is setting up to be the retest of that breakout, followed by a move higher. And again, what did this look like from the 1970s? It was this sort of cup formation that lasted for 3.5 years. We're talking about now a cup formation that is going to last for almost 10 years. And notice how when the price of gold here got close to challenging the 200 high again, it backed off before breaking through. We will likely see something like this around that 1900 level. Of course, remembering what happened in the long run here. Very similar setup as we focus on what is the main technical signal right now. It's this consolidation above a previous high, indicating to us that the downtrend is over. Let's look at silver. A little bit of weakness on Friday. I'm not concerned about this. This looks very healthy to me, and I'll show you why. So let's look at our 3.5-year time frame now. You can see very clearly here we are calling this a multi-year bottoming wedge pattern. Now let's think about a few things. We have an early warning indicator from the price of gold. We've seen that move higher from the price of gold. Silver tends to lag gold. So we're seeing that weakness here over the last couple years, but we know that silver will tend to follow gold at some point. And the question is when, and how will that take form? Now we have another indicator here. This is a very similar relative strength profile that silver is showing relative to the other group of commodities. Notice even here on this little spike that we had, which was only $1.75, $2, silver really outperformed the other group of commodities, world commodities. We saw this exact same early warning indicator in the gold market before the $200 move higher from early January. So this line has been broken here, and this is exactly a perfect setup for the long-term bottom in silver. Why? Because it's showing us this technical break right here, and now it's getting everyone afraid again. It's getting everyone to say, maybe this is not a real break. And this is exactly how these long-term bottoms should form. They scare people right before they get ready to make the next move. Of course, that next move could come from slightly lower prices still. We have a very important $14.50 support level, which held the price for about 3 months back in November, December, and January. If I were a betting man, which I am, I would bet that $14.50 will hold on the downside, plus or minus 10 or 15 cents. And at the absolute worst, I would be looking for a skimming of this broken line, perhaps slightly above and below this broken line, taking us back somewhere to this low here, right around $14. Through the middle part of this year, really kind of wearing people out, getting everyone tired, people losing interest who became interested just here in the last week or two. And then how do these bottoms form when you look at this from this low, one more lower low marginally? We would then be looking for something like a slightly higher low, which matches this low, before we start to round out, perhaps in the strong part of the year again, which is August, September, which corresponds with a lot of seasonal factors, the Indian wedding season, which propels gold higher, and silver begins to follow gold some more again. And we look at breaking through this 1625 level for good and re-challenging 18 before we can talk about some higher targets. Now, could this happen sooner? Absolutely. If gold breaks higher here in the next 4 to 6 weeks, silver is not going to wait for the rest of the summer to linger around these lows. You'll probably see this break of 1625 sooner. This is my worst case scenario. Do we have any more? In addition to silver outperforming the CRB commodity index, do we have other indicators that this may be happening soon? Yes. So here we zoom in, we're looking at the SLV fund. We are looking at the 6-month time frame. We can see the break of this line, a stealth breakout coming right down below, flirting with this line right now, 10 cents or so below this line, depending on the exact levels that we draw it on. And why am I calling this target here higher? Let's switch over to look at one of the lowest cash cost silver miners that is highly leveraged to the price. And that is an indicator that I've been following for about 8 years. And it's not correct 100% of the time, but it's correct the majority of the time. And I like to follow it. It really helps me to make accurate trades and to get a sense of the direction of the market. Notice we are looking at this new high in silver Wheaton above that October high. This is significant. Bringing us back to look at silver again. Silver way below, right? $1.60 below its October high. So what is going on? What are silver Wheaton investors thinking about here? Why are they bidding the price of this company that derives its profits from silver? Why are they bidding that higher? Based on most of the experience that I have with these markets, I will tell you they're bidding it higher because they expect silver prices to be higher relatively soon. So it's another indicator that this is going to be a stealth breakout that really fools people until that next surge higher. So what can we look at here as a model, the long-term model for silver? We've talked about this a number of times, but I'm going to draw a new comparison to another commodity this time. So the 1980 to present price of silver, right? From 1980, the high, this massive multi-decade cupping formation, re-challenging $50 with these increasing price spikes every 2 to 3 years, now backing off to our rising linear trend line, a stealth breakout at exactly that point. Let's look at this comparison, the 400% outperformance of silver even versus the rest of the commodities. Okay, so let's look at the model. We're going to look at another commodity this time. We don't usually look at this. We're looking at copper. Copper being a mostly industrial commodity, right? We usually look at gold, which is mostly a monetary commodity. Silver falls somewhere in the middle, even though it's still the majority industrial at this point. The thesis is that it will regain a monetary premium. Copper is mostly an industrial commodity. So let's look at this. Copper made a high in 1980 at $1.50 per pound. It then lost 2/3 of its value, only to rise by 200% again, only to lose over 50% of its value, to double in value again, to lose 2/3 of its value again. Multiple attempts to break through this $1.50 level, right? Over the course of 20 years, ending in the year 1999. Let's fast forward this by 5 more years through the end of 2004. Look at this. The last chart ended right here, and we had another attempt to challenge the $1.50 level. Basically 4 attempts over the course of a generation. What happened after this? Finally, in 2005, copper broke above the $1.50 former all-time high and roughly had a threefold move above the former all-time high, up above $4. Now this chart ends in 2008. Copper has since come back into the region here in the $2 region, but that's fine. You're still talking a multiple of the former all-time high. So let's look at this period right here around 2000, 2001, 2002. This period right here is where silver is right now. It is making a low, perhaps its final low from a big picture perspective, before, over the course of the next 5 years, we expect the next attempt to challenge the former all-time high, which will result in a similar breakout as gold and as copper have had, to a multiple of the former all-time high. So you pick the multiple. Is it 100? Is it 150? Perhaps. Based on the metric here that copper formed, that would be realistic. This won't happen today or tomorrow. This won't even happen this year. We're talking about a 5-year period to re-challenge the $50 high, followed by a move higher once that level is broken. And that battle around 50 could still take a year, 18 months to play out. This region, the former all-time high, very important to remember. This chart will look the same as the copper chart when we back it out 5 or 7 years from now. We will be talking about these moves challenging 50 as being the times that silver was challenged below the 50 level. And once that is broken, we'll be looking at the similar trajectory as copper had above the $1.50 level, above its multi-decade high, above its 1980 peak. This is what I expect for silver going forward. We see that silver is being accumulated relative to other commodities over the last 10 years. This signal tends to precede significant moves. Thank you again for joining me. I'm very glad to be able to share this research that I do with everyone, and my sincere thanks for anyone who is able to support this work. If you are able, if that $2 per month is within your budget, and only if you find value here. If you do not find value in this work, this is free, and this channel will always be free. So thank you again very much, and I will see you on Wednesday evening.